Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, February 23rd, 2024. As always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is U.S. and global liquidity dynamics look to be generally favorable through 1H24. So the nuance there is yesterday's Fed speak, which included Chris Waller, Philip Jefferson, Lisa Cook, and Neil Kashkari, was universally hawkish. The FOMC minutes from Wednesday also signaled policymakers are broadly concerned about cutting rates too quickly. Elsewhere, China's January property price data exhibited broad-based deflation. In terms of the market implications, we do not believe the current reflation market regime requires monetary easing to be sustained. It merely requires the Fed and/or Treasury to avoid tightening. We are expecting a less favorable policy mix in 2H24, which may include pivoting back to higher for longer forward guidance, which would likely inflate the RRP by increasing the relative attractiveness of ultra short duration exposures within the fixed income asset class. The Treasury could also dramatically boost the TGA post the general election in November to prepare for the expiration of the debt ceiling détente in January 2025. An increase in net bond financing from the depressed 36% ratio of total coupon financing projected for Q2 will also represent tightening. Importantly, we do not see any of these negative catalysts for U.S. liquidity as likely to occur in 1H24. Deepening deflation in the Chinese property market supports our prior expectation of a continuation of the front-loaded policy support we called for back in December. Chinese officials are likely to continue adding to the uptrend in global liquidity, our macro weather model signaled in November. So transitioning to my 42 macro dashboard here, as always, we'll start with some trading range signals from our friends over at Longbow. I believe we had an overbought signal here in the U.S. equity market. Yep, ES1. So yep, that is it right there. So gets about to be booking some gains there. BBC, this is an exposure that should be working in a reflation market regime, so it's oversold here. So if you want to get yourself long so if you're booking gains in stocks and want to rotate into some more commodity type asset classes, that's something that makes sense from a tactical standpoint here, at least according to those probable ranges or those trading ranges. Nasdaq is a little bit overbought as well, as is the Shanghai Composite there. So some overbought signals in the equity space. Also getting an overbought signal here in the 10-year TIPS yield. So that means bonds are oversold. The TIPS, 5 to 10 year TIPS are oversold in that regard. So as always, we'll transition. We'll wrap up with a question from our community here, asking about future data moves. So some major risks out there include how the yield curve steepens and the fallout from commercial real estate debt restructurings. Some people think a big recession is likely. Since none of this is really priced in, where will your machine pick up the first signs of these issues going wrong? And P.S. Are you worried about CRE or the yield curve steepening? So right now, no, we don't need to be worried about CRE in a reflation market regime. Reflation is a risk-on regime. You need to be worried about CRE when the market regime transitions to inflation or deflation, which is the risk-off market regime. So in terms of the three elements of our process, that will be that will give us the best indication, the earliest indication of, okay, it's time to actually do something different because there's a commercial real estate crisis that some are calling for. We're not calling for that at all, but that some may be calling for. If that starts to become true, then we'll start to see that and pick it up in our research. So the three places you are going to find that in our research are in the left tail risk section of our macro scouting report. That's where we think about, the left side of the economic distribution risks, things that are probable and likely to happen that may really start to become more modal outcome the expectations. So things like a potential recession, things like a potential commercial real estate crisis, that kind of stuff will be featured in the left tail risk section. And then if it becomes our modal outcome from a fundamental standpoint, then we'd push it into the modal outcome section. But right now, it's obviously very much not in the modal outcome section of those monthly macro scouting report presentations because, again, it is not our modal outcome. Number two, if you our discretionary risk management overlay, which incorporates the top-down market regime, which again is currently reflation, will be a great place for investors to start to pick up on the changing of the volatility, just momentum signals, and ultimately the changing proper trade recommendations across all the various factors that might be impacted by this. If there's going to be a crisis, then all of the macro factors are going to be impacted by this. So the discretionary risk management overlay will be a great place to find that information, to at least spot those changes in real time so that you can make the appropriate adjustments in your portfolio in real time. Don't forget, it's our job here to make it save money. We're not here to be right or wrong about a commercial real estate crisis thesis. We're here to absorb that information so we can better reposition our portfolios to make and save money. You always got to get back to making and saving money. This is a making and saving money firm, making and saving money broadcast. We don't give a damn about people's investment theses unless they're helping us make and save money. And then the last thing, the last place of our research where we would see a commercial real estate crisis develop or a recession develop is obviously through our growth nowcast. We maintain sophisticated nowcast models for the U.S. and all the major economies in the world. So you'll start to see some of the negative data impact those nowcasts and really start to push the trend of the projections of growth lower. That's something that's obviously not occurring either. So we're all told. We think if there's going to be a commercial real estate crisis or a CO curve steepening that leads into a recession, those are things that may happen. But we certainly don't need to be positioning for those today, because right now we're in like day 3 or day 4 of a brand new reflation regime, which obviously came off the back of the Goldilocks regime we called for back in November. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, February 23rd, 2024. Everyone have a wonderful day out there. Best of luck. Have a great weekend, and we'll catch you back here on Monday.